Welcome to G2 Weekly Market Update, where we break down the key market moves and economic developments across the US, Europe, China, Japan. Global markets had a volatile week, driven by trade related headlines, shifting policy expectations, and mixed economic signals. Let us take a closer look at what moved markets this week. United States. US equities ended a holiday shortened week modestly lower, with mid cap stocks underperforming broader indexes. Markets were closed on Monday for Martin Luther King Jr. Day, and sentiment weakened early in the week after renewed trade concerns surfaced. Stocks fell sharply on Tuesday following comments from President Donald Trump about potential tariffs on European nations, before rebounding midweek as those tariff threats were later softened. Despite the recovery, major indexes finished the week below recent highs. On the economic front, US growth remained strong. Third quarter GDP was revised higher to an annualized 4.4%, supported by stronger exports and business investment. Inflation, however, remains sticky, with core PCE rising 2.8% year over year, still above the Federal Reserve's target. Labor market data stayed resilient as jobless claims remained near 2 year lows, while consumer sentiment improved modestly in January, even as households continue to feel pressure from elevated prices. Europe. European equities declined amid renewed trade and geopolitical uncertainty. The Stocks Europe 600 and major regional indices all finished lower for the week. Business activity across the Eurozone continued to expand modestly, with composite PMI readings holding above the 50 level and business confidence reaching a 20-month high. The UK also showed signs of economic momentum, with PMI data pointing to stronger growth. However, challenges remain. The UK labour market continued to weaken, inflation unexpectedly ticked higher, and wage growth slowed further. Central banks stayed cautious, with Norway's central bank holding rates steady and signaling potential cuts later in the year. Meanwhile, the Europe Mercosur trade agreement faced delays after the European Parliament sought legal clarification, adding uncertainty to Europe's trade outlook. Japan. Japanese equities moved lower during the week as political uncertainty and fiscal concerns weighed on sentiment. Prime Minister Sanai Takaichi's announcement of an early election combined with a proposed temporary cut to the food consumption tax raised investor concerns over government finances. These worries pushed Japanese government bond yields to their highest level in decades. The Bank of Japan kept interest rates unchanged while signaling readiness for further tightening if inflation and growth trends remain intact. The yen remained volatile, particularly after Bank of Japan officials expressed discomfort with rising long term bond yields and signaled a willingness to intervene if market volatility intensified. China. Chinese markets delivered mixed performance, reflecting uneven economic momentum. While China reported full year growth of 5% in 2025, fourth quarter growth slowed to 4.5%, marking the weakest pace since the post pandemic reopening. Industrial production showed some resilience, supported by export demand, but domestic demand remained soft. Fixed asset investment declined for the first time on record, and retail sales growth remained subdued, highlighting ongoing pressure on consumers. Looking ahead, analysts remain cautious, noting that rising global protectionism and tougher year on year comparisons could weigh on China's growth outlook in early 2026. G2 takeaway. This week highlighted the growing impact of policy uncertainty, trade dynamics, and inflation persistence across global markets. While economic growth remains resilient in key regions, investors are becoming more selective as fiscal risk and geopolitical developments add volatility. Staying diversified and focused on fundamentals remains critical in this environment. That is for your G2 weekly market update. Thank you for watching, and we'll be back next week with more insights on global markets and economy. Thank you.